Alright, so you've probably noticed that the yield on the 10-year benchmark government bond has crossed 6.4%. It crossed that mark for the first time in over a year, and in fact it closed at 6.41% for the first time since April of 2020. You're probably wondering why this is significant and why it's happening. Well, you have bond yields across the globe that have climbed on account of what is happening in the US. You have inflation that has been persistently high. It came in at several decade high in the most recent print, as a result of which the US Federal Reserve has come in with a very hawkish statement in the recent past. It announced that it will be fast forwarding its taper of quantitative easing, and it's also going to take up at least 3 rate hikes in the year 2022, and that's pushed yields higher across the board across the globe. You also have other monetary policy authorities, central banks in major economies, rolling back easy monetary policy that was used to weather the storm that was COVID-19. Now, what's happening in India is that you've had persistently high inflation. Core inflation, which removes food and fuel, has also been very sticky, and the RBI is anticipated to come in and curb that at some stage. So this is moving up. The yields are moving up in anticipation of that. There's also another factor that is playing out, and that has to do with liquidity. Liquidity has been maintained at very high levels because the RBI wants to facilitate growth in the economy. It is also looking to normalize that in the near to medium term. It doesn't want to jostle the system, but it's also started doing longer term repo auctions in a bid to normalize liquidity. What is likely to happen, according to market participants, is that the benchmark for short term rates, which is currently the reverse repo, is going to move to the repo rate, and that will push yields on the short end of the spectrum higher. So what you could see, according to market participants, is that the yield on the 10-year benchmark government bond could move probably about 10 basis points higher in the next 3 to 6 months, but you'd see a much sharper 30 to 40 basis point move on the short end of the spectrum, and that will cause what is called a flattening of the yield curve. This is something that was anticipated to happen. It is likely to play out over the next 3 to 6 months. You're probably wondering what all of this has to do with you. Well, what happens is that financial institutions are dependent on these bond yields, and in order to manage their assets and liabilities, banks in particular, they have to adjust the other end of the spectrum, which is deposit rates. And you've already seen a few NBFCs as well as State Bank of India move to increase deposits. So this is something that will pan out over the course of the next 3 to 6 months. Of course, when the Monetary Policy Committee of the Reserve Bank of India decides to actually raise rates to counter inflation, something that could happen in the next year, calendar year, you could see a much faster move in the yields. But for now, a flattening of the yield curve is what is to be expected, and this is really normal. It's something that was expected.